This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. A weaker lead in for Asia as the tech sell-off halts a 7-day rally on Wall Street. Fresh US economic data giving support to the Fed's cautious stance on rate cuts. Bloomberg reveals that the FTC has launched a Microsoft antitrust investigation demanding information on its cloud, software and AI products. And Mexico hits back at Donald Trump's latest tariff threat, saying it would hammer the US economy and fuel inflation.
Yeah, and we're already seeing inflationary pressures accelerating in the U.S. because we got the Fed's preferred measure of inflation. And core PCE came in line with estimates, Haidi, but it was still picking up and really driven by service prices, right? I mean, we saw a surge in portfolio management fees, not surprising given this stock market rally that we're seeing. We also got third quarter GDP numbers coming in solid and really driven by consumer spending. So not surprising right now. We're seeing a more cautious stance coming from the Fed and really in question whether or not they will actually cut rates in December.
And speaking of rates, of course, all of these other central banks are also watching not just the Fed now, but also the trajectory and the impact of potential trade tariffs and the potential other policies that we could see from the incoming Trump administration and how that play out for global inflation and growth levels. And we're looking at the Bank of Korea decision, and it's a really difficult juggling situation for the BOK, right? Because on the one hand, when it comes to the domestic side of the economic indicators, arguably they should already be easing or should be thinking about easing. We've seen the won really coming under pressure, but they are still likely to hold as they continue to weigh the impact of some of these external challenges that we've been talking about, external implications of the Trump election victory. But we're still sort of seeing the first interest rate cut in more than 4 years last month. The idea, though, is perhaps that, they should be continuing along that cycle given the weakness that we've seen in some of the domestic activity indicators. But, of course, the debt levels are also one to be concerned about as well. And that's going to be the balancing act for the BOK. When it comes to the currency, we have seen the Korean won falling to a 2-year low earlier this month, and that's really a pretty big reflection of the worries about Trump policies on trade. Of course, Shery, as we both know, the Korean economy is so externally vulnerable, particularly when it comes to the weighting of chip and tech exports.
And it's really not only about the South Korean economy, but many exposed Asian economies, right? We had the RBNZ again cut rates yesterday, but we actually had the Kiwi dollar extending those gains to 1-week high, given a more hawkish than expected outlook for 2025. So we'll be watching that market and the Kiwi dollar as well today. And take a look at how we're setting up. The ASX 200 in that staggered open up 0.2%. Well, we're seeing Nikkei futures really not doing much, but we had significant pressure for Japanese stocks already. The Japanese yen, in fact, rising in the overnight session to around that 151 level, which is also quite interesting because we're seeing a little bit of yen buying towards year end. We're also following right now the offshore yuan, not doing much, but of course that a lot to do with tariff news around that additional 10% on Chinese goods, according to President-elect Donald Trump. But take a look at how we're setting up in the U.S. session, because we have really tech stocks dragging U.S. markets from that record high that we saw. We're talking about the 52nd record high already. But a factoid here, according to some data, we're hearing that when it comes to Thanksgiving to year end, usually the S&P 500 appreciates about 1.8% on average since 1950. So do look out for that as we get started this holiday shopping season. But it was really a thin trading session given that it was ahead of the Thanksgiving holidays. We were looking at crude prices also right now holding steady at that $68 a barrel, Haidi.
Let's get to our top story now, one, of course, with some pretty big market implications. Bloomberg has learnt that the US Federal Trade Commission has opened an antitrust investigation into Microsoft. We're told that they're drilling into everything from the company's cloud computing and software licensing businesses to cybersecurity offerings and AI products. Our legal reporter, Josh Cisco, helped break this scoop and joins us now. And Josh, we appreciate your time, particularly in this holiday week. But what do we know?
So we know that it's essentially the beginning of what it was going to be a long process. The FTC has been kind of building up to this for about a year, interviewing competitors, customers, looking over documents a little bit. But now they've sort of have officially compelled Microsoft to produce will end up being like a tremendous amount of material, documents, interviews, the whole bit, and it could be the beginning of a lengthy process.
And already at a time when we've seen other moves against Google as well, but if we get this new administration, Trump 2.0, where he's talked about more deregulation, about government efficiency and so forth, what sort of changes could we see in this approach?
So that's a good question. It's a little bit hard to know. I mean, if it's not terribly difficult for a new administration to want to sort of slow this down, if they wanted to take a different sort of tack. But, you know, the first Trump administration was pretty aggressive against tech companies. The Trump DOJ sued Google, the Trump FTC sued Facebook, or now Meta, and this would be just the next major tech company to face one of these sort of massive investigations, and I wouldn't expect this to be, you know, just automatically slowed down. I think there's a good chance it could move forward.
So that's sort of regardless of, you know, it's Mina Khan or not, right? You mentioned that this is the beginning of a lengthy process. Do we know what the sort of process is going to look like and how drawn out these things tend to be?
Yeah, I mean, these investigations can take several years. You know, I think Google and Facebook and Apple and Amazon were all investigated for at least 2 to 3 years before lawsuits were filed. And I mean, if I would expect that to sort of hold here as well. And then at that point, if the government decides, you know, it has enough evidence to bring a case, it'll file a sort of a major monopolization case against Microsoft. But before that, you know, they're going to talk to every one of Microsoft's competitors, as many customers as they can. They're going to look through sort of what will probably be petabytes of data. It's just going to be a very long, sort of cumbersome process.
Legal reporter Josh Sisko there with the latest on Microsoft, which is falling right now in the after-hour session about 0.4%. We continue to see that downside pressure on these tech stocks. Of course, overnight we saw that breakdown in the tech trade, especially with the Magnificent Seven dragging down the broader markets after an incredible rally over optimism on artificial intelligence. Our next guest says the demand for AI is still strong, but that some tech names are stretched right now. Chung-In Yoon is founder and CEO at Fibonacci Asset Management Global. Chung-In, great to have you with us. What do you make of this sort of sell-off that we continue to see in tech names? And does it concern you that we're seeing perhaps a hit in the broader markets?
So when it comes to the valuation of tech stocks, some of them have a P ratio over 50 times or nearly 60 times. And you have to question the sustainability of the earnings of these tech stocks, especially in the light of new economic data that indicates that Fed might sustain or drag down the rate cut process in the future. So we are seeing a U.S. Treasury yield holding a 4.5% level for the short-term notes between 1 to 3 months, and even the 10 years are above 4.2. And if this level of interest rate is going to hold, it's questionable whether these tech stocks can justify the current valuation.
What do you expect the Fed to do in December?
So after core PC came out, some traders are questioning if they should be prepared for the no rate cut in December. And I think the chance of that is becoming increasing due to the fact that the pace of U.S. economic expansion it seems to be gaining momentum and accelerating.
It's interesting you say, you know, for all of the market uncertainties, you say that there's a better understanding of what to expect from the incoming Trump administration, right? When it comes to how markets are pricing those risks, do you think there's underpricing or perhaps too much exuberance when it comes to the Trump trade?
So Trump's tariff will probably push the inflation rate even higher. And that's bad for those who expect Fed to cut rate aggressively next year. And we are gaining more understanding of what the Trump 2.0 will look like, and there'll be more tariff, there'll be more control, and more frictions between allied countries trying to export goods to the U.S. market. And I think this tension will go on through the first half of the Trump's administration. And this isn't going to be good for the U.S. economy. This isn't going to benefit, and it will also mean that the level of interest rate that is at the moment can be sustained or persist much longer than expected.
What about the landscape when it comes to geopolitical risk, right? Do you think there is, under the broader sort of approach of what we know from the former President Trump, but not to mention perhaps a diminishing of some of these geopolitical tensions, do you think there is a better environment for energy and energy-related assets?
So I think this is a silver lining for Trump 2.0. We'll probably see ceasefire in both Middle East and Ukraine coming soon. Also, Trump administration wants to export more oil by producing more oils. That will probably put pressure on the oil price as well. In this environment, a petrochemical company can probably expect better margin due to lower prices. Also, it's good for a certain segment like aviation or traveling stocks as well.
And of course, depending on how those tariffs are imposed and when, we could see a big impact across Asian economies. We do have the Bank of Korea's decision today. Are we expecting the governor to wait a little bit more until there's more clarity come next year around geopolitical conditions, around trade, around, of course, the South Korean economy as well when it comes to another rate cut?
So we expect no cut this month, and we'll probably see Bank of Korea trying to cut the rates 3 to 4 times next year. And that's mainly because the economic outlook for Korea is not good. Goldman Sachs predicted that its GDP growth rate can fall down to 1.8%. or even lower if the tariff starts to kick in. So there's a real concern for BOK for the rate, but it also has concern for the inflation, which puts BOK in a very cautious mood.
Juliana Yuan, who's the founder and CEO at Fibonacci Asset Management Global. Really great to have you with us. More ahead on the Asia trade. This is Bloomberg. Mexico is warning that President-elect Donald Trump's threat of 25% tariffs on Mexico and Canada would cost the U.S. economy and increase prices for American consumers. Bloomberg's Eric Martin joins us now from Washington. So we're seeing that further reaction to these trading partners. And what are we hearing from Mexico in terms of the, unintended consequences for the American economy?
Absolutely, Heidi. Well, the focus has been on trying to convince, so far from the Mexican government, convince President Trump and his administration publicly that this would be an own goal for the U.S. to apply these tariffs, that it would be the U.S. and the Trump administration shooting itself in the foot. The Mexican economy minister today highlighting that by Mexican calculations, these tariffs would raise the average cost of a pickup truck by about $3,000 per vehicle. So trying to appeal to the rationale of some of Trump's voters, particularly those, kind of who are pickup truck drivers. I mean, kind of a blue-collar type of dynamic and of audience there and consumer to some degree, and really trying to highlight for the U.S. the self-interest in avoiding these tariffs and in negotiating with Mexico and with Canada to preserve free trade in the region.
It was really interesting to see that these tariff threats and announcements came even before President Trump took office, right? I mean, his transition team has been pretty busy. It seems we have new nominations as well every single day. The latest one could be when it comes to a special envoy for Ukraine and Russia.
Absolutely. We're seeing President-elect trying to put his imprint on foreign policy nearly 2 months before taking office. We had today the announcement of Keith Kellogg as a nominee for special envoy to Ukraine and Russia. And he's said some pretty forward-leaning things about trying to bring this conflict to a close, has talked about the possibility of a demilitarized zone, also suggested potentially cutting off arms shipments to Ukraine and trying to both use kind of carrots and sticks to try to bring this conflict to a close. And some ideas that are fairly controversial out there in terms of suggesting potentially diminishing support for Ukraine, but a feeling and a reading like this conflict could really go on forever with the U.S. supplying Ukraine in a war, in the conflict that potentially Ukraine cannot win, cannot achieve an ultimate victory. And so then questioning what is the objective of involvement and support for Ukraine.
You know, it's interesting, we've talked about even before his move back into the White House, we've seen President-elect Trump, but not just the President-elect, but also his advisors, right? Namely, Elon Musk really trying to put his own stamp on government and policy going forward. And we're now hearing that Elon Musk, who's of course been tasked to slash federal expenditure and bureaucracy, saying that we don't need to have the Consumer Financial Protection Bureau.
Well, it's quite fascinating, right? Because the Consumer Financial Protection Bureau is a relatively young bureau. Only in the Obama administration was it created kind of out of the ashes of the global financial crisis, with a lot of the intellectual firepower behind it coming from then Professor and now Senator Susan Warren. And so this has been a target for Republicans and for people who criticize and feel that the U.S. government over-regulates. It's been a target for a long time. And finally, a belief that with some of the proposals being put forward by Elon Musk, by Vivek Ramaswamy in terms of this DOGE and this Department of Government Efficiency, that potentially this could be one of the first places hit in terms of trying to pare back some of that regulation that some Republicans and some Trump supporters feel like has been over-involvement and over-regulation of the government in the American economy and with American consumers.
Bloomberg's Eric Martin there with the latest on everything that's happening in Washington right now. Of course, we have all of those nominations, and Haidi, we continue to watch what the implications are when it comes to economic policies. And a lot of traders right now pricing in potentially more inflation, given that some of President-elect Donald Trump's policies could lead to higher prices. That's sending the dollar higher. And on the other side of that trade, of course, we have the immense pressure on emerging market currencies. And we already talked about, say, the Chinese yuan falling to a 4-month low against the U.S. dollar, given those additional tariffs that were threatened by Donald Trump. But also we had the Mexican peso falling to a 2-year low. Also idiosyncratic news like Brazil, for example, which lost more than 2% at one point overnight, its weakest since 2020, with the president there, Lula, proposing income tax exemptions and public spending cuts. So we continue to see this massive pressure on the EMFX.
And of course, it's a China story there as well. And China is just one of the economies that are so wary when it comes to the actual application and rollout of Trump's tariffs and perhaps some other, punitive trade policies as well. And we are seeing kind of these bearish calls when it comes to the yuan continue. And the yuan is kind of always been seen as this anchor to the core, to that EM basket, not just of FX, but EM risk assets more broadly. And we're hearing that China China's yuan could appreciate by a further 10 to 15% in response to trade wars unleashed by Donald Trump. JPMorgan economists are predicting an average effective tariff of 60% on China. That could slow growth to 3.9% from 4.8%, or around 5% is the target in 2024. So that trade shock is really forecast to slow really broadly that EM growth picture to 3.4% in 2025. JPMorgan also seeing manufacturers in EM Asia and Mexico being hit the most there as well. So this, of course, on top of the domestic structural slowdown challenges that Beijing is facing. It's certainly a tricky time ahead when it comes to that EM space, Shery. We do have more ahead, including more analysis on this story on the Asia trade. This is Bloomberg.
You're watching Daybreak Asia. These are the latest from the corporate front. The U.S. Federal Trade Commission is investigating Uber over whether it violated consumer protection laws with its subscription service. Documents viewed by Bloomberg showed the FTC is looking at the enrollment and cancellation aspects of the product. The Uber One service provides discounts on rides and delivery orders for an annual fee. Shares of Chinese driverless tech firm Pony AI tumbled in their U.S. trading debut, erasing an early pop. The company's shares closed at $12 each in New York, $1 below the IPO price. Pony AI raised $413 million through its listing and private placement after delaying its pricing by a week as the firm boosted the deal size and addressed regulator questions. Later, we'll hear from Pony AI's co-founder and CEO James Peng on what's next for the company after its U.S. trading debut. That interview is happening at the times listed on your screen.
Shery, take a look at how we're trading when it comes to Australian assets. This is a picture just under half an hour into the start of trading. And of course, we're starting to get some of that holiday thinning when it comes to the handover from Wall Street with Thanksgiving week. But pretty buoyant when it comes to Australian stocks. We're seeing upside of just about 0.5%. We did see that real rise when it comes to banks and consumer discretionary stocks holding those gains in the previous session. Inflation for October coming in below the forecast of 2.3%. We also saw some of those key drivers that have been stubborn, like rental costs, starting to come down as well, thanks to government rebates. So that's giving a little bit more hope that there's more scope for the RBA to move a little bit sooner. And watching the Aussie dollar as well, pretty steady, but kind of clawing back to that 65 level as we see some of that China proxy risk fading there as well. The dollar has been weakening, though. The yen has been outperforming. So it is broadly a G10 story versus the dollar, given that we have seen that rise in the euro putting pressure on the greenback as well.
Yeah, very interesting what you're saying in the currency space, right? Because we're also contending with month-end flows, and we're nearing the end of the year. We're also thin trading because, of course, we're headed towards Thanksgiving in the U.S. But you have the Japanese yen now at that 151 level against the U.S. dollar. Crossing 150 would be quite the news. But take a look at the offshore yuan right now, not doing much after falling to that 4-month low against the U.S. dollar earlier this week on those tariff threats. The euro not doing much, but we've heard several calls already that we might reach dollar parity within the month or at least next year or so. And emerging market currencies right now seeing a little bit of a boost given a weaker dollar, but we've seen significant pressure on that side already. We have more ahead on the Asia trade. This is Bloomberg. The Bank of Korea is set to release its rate decision in the next hour. It's widely expected to hold. We continue to see policymakers in South Korea weighing the impact of their previous rate cut and also, of course, the incoming Trump administration and the uncertainty surrounding the U.S. Bloomberg economist Hyo-sung Kwon joins us now from Seoul. Hyo-sung, it's such a tricky situation for Korea, right? I mean, you have a weakening economy, but at the same time, you have a weakening Korean won. So what are we expecting today?
First of all, thanks for having me. I expect the Bank of Korea to hold its base rate at 3.25% today. because the economy's performance is starting to disappoint. The export is slowing rapidly, and then domestic demand remains weak due to high debt burdens of households and property developers. But I think the BOK would be cautious adding more pressure to the won, because you mentioned that the Korean won is under intense pressure currently due to concerns about the incoming Trump administration trade policy and market expectations for high U.S. interest rate. So I think the BOK would take a wait-and-see approach today, and then I expect the Bank of Korea to cut interest rate in January next year.
There are some sort of critics that say that, perhaps they shouldn't be waiting that long, right? But does the domestic debt situation really prove to be an ongoing concern?
Well, I think, yeah. Well, at this point, that probably the more concern would be the weak the currency value of the and you mentioned that high debt level is also concern. That is true, but at this point, BOK's bigger concern is exchange rate, and at the same time, I think even if some people argue that the BOK needs an urgent rate cut, but from my perspective, BOK is not way behind the curve, because current interest rate 3.25% is not very far from the neutral level, which I estimate 2.5%.
Bloomberg Economics career economist Hui Sung-hwan there ahead of that BOK decision. Ahead of that BOK decision, we are also seeing an interesting rotation when it comes to risk assets in Korea, right? Of course, we've been talking, Shery, so much about the ascent in crypto, and in fact, it does look like that $100,000 milestone is being flirted with again after that brief pullback. But it's having an interesting sort of response when it comes to reallocation of assets in the Korean markets. We're seeing that Bitcoin rally proving to be pretty bad news for Korean small caps. The KOSDAX index has fallen about 8% since Trump's election win. And really, it has been the impact of this rally in encouraging investors to basically reallocate, to sell their shares in small caps to invest in Bitcoin. And that's been exacerbating the decline of the stock index. So we've seen an almost 35% jump in Bitcoin since the election win on November 5th. The small cap dominated KOSDAQ index has fallen 8%, and it is at this point on track to be Asia's worst performing index this year. So it seems like investors are dumping these small cap stocks to put their money into Bitcoin, Shery.
Yeah, I mean, it's interesting, right? I mean, money and capital has to come from somewhere, especially when we're talking with Hyosung just now, a heavily indebted economy like South Korea, where you have household debt being so high. So this is a very interesting story, that reallocation of Korean assets into Bitcoin. But let's move on to another story, because now we're hearing from JPMorgan that China could allow its currency to depreciate by as much as 10 to 15% in response to any trade war unleashed by U.S. President Donald Trump. China correspondent Mimi Lo joins us now with more on this. So what are analysts saying right now about China absorbing the tariff shock? And I mean, let me rephrase that, because I called President Trump, and let's remind viewers that he still hasn't taken office, but we're seeing all of these tariff threats and so much news coming from the transition team. What could we expect from a potential tariff shock if implementation does actually happen?
Yes, indeed. And if you go by what China did back in 2018, 2019, China had allowed its currency to depreciate by about 28 to 30% to offset 70% of the rise in tariffs during Trump's first administration, first term in power. But JPMorgan is predicting that China will now allow the currency to depreciate as much as just 10 to 15% this time. A slightly more moderate here, perhaps fears around capital outflow and upsetting financial stability volatility would restrain the PBOC from allowing the currency to depreciate too quickly. If we just judge by the past 2 weeks alone, we have seen the PBOC setting the fix stronger than 7.2 yuan per dollar. But JPMorgan is also expecting that this would hurt China's growth by slowing it down from about 4.8% this year to 3.9% next year. And EM markets will be heavily affected as well, especially the manufacturing exporters from the likes of Malaysia and Vietnam. They might be most affected. They're expecting EM growth to slow from 4.1% this year to 3.4% next year. And meantime, you have Bank of America warning that investors appear to be underestimating the impact of a trade war. They're saying they could see EM currencies as a whole, on average, depreciating by about 5% in the first half of 2025.
You know, and it's interesting, we've been sort of combing the rhetoric from Donald Trump's pick for the top US trade position. His pick for the US trade rep is Jamison Greer, of course, who has spoken about China as being a generational challenge. He thinks a permanent strategic decoupling and a revoking of the current sort of trading and bilateral relationship is in order.
Yeah, so Greer, we know, has been a long-time China hawk, and we were able to glean a little bit about his thinking behind his China policy through his speeches in the past. And he has proposed before to end this normal trading relation status with China. And that is something that was granted to China back in 2000 when China was preparing to enter the WTO. By ending that status, it essentially puts China in the same category as the likes of North Korea and Cuba. It would mean more levies on Chinese goods, for example. He's also proposing that Congress pass a law to protect U.S. companies from retaliation from China. And that could look like, for example, compensating American companies who are not allowed to sell to China and taking action against foreign companies that are taking advantage of this trade war. For example, taking action against a Brazilian soybean company that is selling or backfilling orders to Beijing because U.S. companies are not allowed to sell to the Chinese market. He has also proposed that the executive branch of the government be given the authority to ban any outbound investments into China that hurts U.S. Economic and national security. And he also proposed tightening custom rules, limiting the entry of Chinese goods that are made in other countries or that have goods that have a high level of Chinese content. And this could affect sectors like the automotive sector that is very heavily, built with Chinese parts, as well as products made by Chinese companies in Mexico, for example. Many Chinese companies have been shifting production to Mexico to take advantage of that free trade agreement between Mexico, the U.S., and Canada.
And you mentioned Brazilian soybeans, but the fact is that China is still not just buying from Brazil, but also buying from the U.S., right, despite this threat of a potential trade war.
Yeah, this came as a surprise to some traders who were expecting shipments to slow down. But according to traders who are familiar with the sale, a Chinese state buyer continued to buy at least 8 cargoes of these soybean last week. Apparently, another 2 cargoes were sold this week, according to data from the U.S. Department of Agriculture. And in some ways, it's not surprising because analysts are saying that China will want to keep its foot in as many doors as possible. In the meantime, it will not want to buy 100% of its soybeans from Brazil. But the risk of this is if a trade war erupts the moment President Trump is inaugurated in January and these shipments have not yet arrived in China, they could be stuck at sea if the tariffs arrive before the vessels. So that is the risk there. But it looks like the Chinese state-owned companies are buying these soybeans to stockpile them to build up their national reserves.
Bloomberg's China correspondent in Minlo there. Let's take a look at the view when it comes to commodities, because, of course, as we've been reporting, this major trade of soybeans at this point at least continues. We have seen, though, some of the sort of related elements, soy oil, for example, dropping. We've got the supply situation there really overshadowing any Trump tariff threats at this point. We are also seeing some of those gains when it comes to other agri commodities like palm oil as well, some of the more environmental and rain-related factors are at play there. When it comes to broader trading across commodities, this is a picture when it comes to oil. It's like a little change, a little bit at the upside, just very thin trading in terms of volumes ahead of that key OPEC Plus meeting. The focus is on this weekend, of course. They're widely expected to once again delay restoration of production when it meets on that Sunday to offset these concerns about what is an anticipated glut situation next year. But we have seen when it comes to trading in this market, the US side really ramping down before the Thanksgiving holiday. We have been pretty much stuck in that tight range since about early October, with some of these prices, the momentum being buffeted by geopolitical concerns in Russia and in the Middle East as well. We are also watching coffee. We spoke about this yesterday when it comes to just the price action. Arabica jumping to the highest since 1977, and that's really going to create some woes when it comes to some of these coffee chains, in particular watching some of the ones in China as well. But coffee futures at the moment still sitting at the highest point in just about 40 years, with some of these drought concerns in Brazil, dryness in Vietnam, with that 70% increase in Arabica bean prices this year. We do have more ahead on the Asia trade. This is Bloomberg.
Hong Kong Airport's third runway starts operations from today, but it could take at least another year for the hub to reach its full capacity. Bloomberg's transport reporter Danny Lee joins us now from Hong Kong. So what's going on, Danny?
Yeah, Hong Kong today starts its 3 runway operations. They spent $18 billion and several years building it, and this comes amid backdrop of other regional rivals, whether you see Seoul or Bangkok or Singapore, all trying to expand their airports as well, key to their economic growth and to growing the economy overall. But for Hong Kong, this new runway comes at a time where it's struggling to attract long-haul airlines to come, because airlines have to transverse Russian airspace or go around it. Demand is not quite there, and since after COVID, there's not been as much of an appetite to come to Hong Kong outside of mainland China. So for now, the new runway which arrives is going to be a key test to see just how much it can help boost Hong Kong's flagging economy.
Yeah, Danny, I suppose the question is, whether this is kind of necessary given the volumes for demand, right? We are getting into a busy period, holidays, and then, of course, going into an early-ish Chinese New Year, Lunar New Year celebrations as well. What is the outlook when it comes to that aviation recovery for Hong Kong as a hub?
So in the short term, the likes of Cathay Pacific, they look set to benefit from that early-ish Chinese New Year, Lunar New Year period. They actually said they expect now to recover 100% of their pre-COVID capacity by January. So that's a significant milestone in terms of just seeing properly the back of COVID. And then with the third runway at Hong Kong Airport, all 3 runways operating, they can look forward to growth and expanding once again. But clearly, with the airport kind of restraining that extra growth because of the lack of demand, it remains to be seen just how much of a benefit everyone can get from extra flights potentially in the near term.
Bloomberg's transport reporter Danny Lee there with the latest. And one forecast from the American Express Global Business Travel Group says airfares are set to increase next year due to higher costs and supply chain disruptions. Let's get more perspective with aviation analyst Geoffrey Thomas. And, Geoffrey, I thought prices were supposed to finally be sort of normalising, but is this level of disruption and sort of risk premium really the new normal?
Look, it certainly is for the time being. One of the dynamics of this, as alluded to, is capacity shortfall in the market. One of the problems is the Airbus A320neo. The aeroplane itself is fine. Its engine, the geared turbofan is not. Premature wearing of parts. So the result of that is there's about 600 of these aircraft grounded around the world. That number is coming down as Pratt & Whitney effect the repairs that are required for this engine. So we have a very big problem with capacity. And as your transport writer and reporter suggested, Cathay Pacific only back to full capacity in January. Qantas down under in Australia, still waiting for a couple of A380s to come back from heavy maintenance, because during COVID, with all these aircraft grounded, a lot of them required extensive maintenance after COVID had finished, and there was only limited capacity around the world to maintain these aircraft, to do these overhauls.
Yeah, and some of that capacity, particularly when it comes to the labour market and associated industries, may not come back, right?
Look, yes, and with the labour market, the airline industry lost $300 billion through the COVID period. They also, with tourism, lost 46 million people were laid off. A lot of those folks have not come back to the industry. So we've got labour shortages, we've got part shortages, we've got aircraft shortages. All of those issues are driving cost up. Capacity is really tight. Therefore, airfares are more expensive. And of course, we've got inflation, which is, as we all know, impacting everybody right across the globe.
How do you factor in potentially higher tariffs coming from the Trump administration around the world and the impact on trade and just the aviation industry in general?
If the Trump administration delivers as per the election promises, then we're in for a very turbulent time. However, I think the reality of some of these suggestions will sink in once the administration gets into office. For instance, Canada, the biggest export Canada has to the United States is oil, and that's approximately $150 billion worth of oil for $35 billion worth of gas. Now, if you hike a 25% tariff on Canadian goods, which is what has been suggested, the fuel prices for those American voters who voted for Trump will be going through the roof. So I think I think a lot of it's rhetoric. Hopefully that proves to be the case. But a tariff war like has been suggested would be a very turbulent, very difficult period for not only aviation but the world trade globally.
When it comes to building capacity overall in the industry, how do you overcome the labor shortages that we just talked about? Because this is really a long-term process of having people in the pipeline and having really these skills being developed by a lot of young people that need to come into the industry. What's happened after COVID, and where are we in that recovery?
That's a very good point, attracting people back to the industry, because there's two aspects to it, the actual salaries they're paid and also the security. A lot of folks that we've talked to who have left the industry say, I don't want to go back because what happens to the next pandemic? I lose my job again. I've now got a more secure job. I've got a better paid job. So that's a very big challenge for the industry, and I don't quite know what the answer to that is. However, we've just seen Boeing agree to salary hikes for their machinists nearly 40% over the next 3 years. That's going to increase the cost of buying a Boeing aeroplane, and I would imagine Airbus has the same problem. So therefore, the price of aircraft is going to go up. Therefore, the price of fares is going to go up. I think we're living in a new world order, if you like. I don't think we'll ever get back to 2019. And so we're going to be living with fares that are higher than they were before. And there's not much we can do about that.
In a way, I think travellers in Australia might argue have been in this new world for quite some time, right? There's been so much criticism and inquiries into alleged price gouging, monopolistic behaviour. Lots of disruptors have come and attempted and faded away. What's your view on what's going on with this industry in Australia? And you know, one of the airlines would say it's also the deregulation of airports that's the factor here. Why is it so particularly bad when it comes to Australia?
Well, it's a very interesting question. The tabloid media has been beating this drum for a couple of years and very much focusing on Alan Joyce. He's now gone, but the rhetoric has still continued. In actual fact, I know what the headlines say, but in Australia, the fares at the moment are, in fact, lower than they were in 2019 as far as domestic is concerned. Now, I know that's completely contrary to everything we would read in the tabloids, but when you do look at the statistics, the index has gone with business class. It's gone down from 85 to 55. Economy has gone from 100 to 95, and best discount is 66 to 65. So there's only been a small reduction there, which I guess is what most people focus on, is the discount economy fare. The demise of Rex and Bonza, yes, there's been a spike up since then for sure, but the question then is asked, well, you know, why did Rex jet operation collapse, and why did Bonza collapse? Well, possibly because they were charging too little. So, but there are peaks and troughs everywhere at the moment. It's a very volatile situation, and it depends on where you pick to make your comparison. But certainly, yes, fares generally are up. I don't think they're up. I don't think it's as bad as reported, and we have to look at some of the numbers with caution.
Geoffrey Thomas, good to have you with us, founder and aviation analyst at Geoffrey Thomas on air. We have more ahead on the Asia trade. This is Bloomberg.
We have breaking news on a deal that we've been watching for some time. BlackRock has agreed in a preliminary deal to buy HPS for close to $12 billion. That's according to the Financial Times. This is the acquisition of the private credit group HPS Investment Partners, one of the biggest players when it comes to the fast-growing private credit industry. They've been working towards an IPO this year that would have valued it at about $10 billion. We're waiting for confirmation to that, but it really is just the latest when it comes to BlackRock and Larry Fink turning to big deals to get BlackRock in front when it comes to the private asset space. HPS follows Millennium as well as GIP and Preqin.
This is the Asia Trade. We're counting down to Asia's major market opens after tech stocks dragged down U.S. equities overnight. Haidi, we have an antitrust investigation that we're watching on Microsoft. But this hour here in Asia, it will be all about the Bank of Korea. No rate change expected there.
And really, it's such focus when it comes to the policies expected from the incoming Trump administration, right? So many of these Asian economies and central banks may have to reshuffle their initial plans and trajectory going into next year because of these implications, particularly for these very externally exposed and trade exposed economies.
Not surprising, we had that downside pressure on manufacturers, on exporters in Japan all this week. Take a look at how the Nikkei is going to come online, because we've been watching the Japanese yen also strengthen. We have seen those haven flows into the yen, not to mention some yen buying towards month end. Of course, there's also a little bit of thin trading given that we're headed towards the U.S. Thanksgiving holidays. And it's just the start of the shopping holiday season around the world, right? Take a look at the Japanese yen right now, weakening a little bit against the U.S. dollar. That 151 level still that we're watching right now, and on watch for that 150 level if we cross it. The Nikkei down 0.5%. The topics also under pressure. Take a look at how the Kospi is also coming online. We have seen a little bit of strength for the Korean won this week. For the past 3 sessions, we're seeing it not change that much. Still around that 1390 level. And of course, the Korean won and the pressure that we've seen there throughout the year is something that the Bank of Korea will be watching. Of course, financial stability, a key concern for policymakers there. But this week, we've seen a little bit of upside, given that we continue to watch the implications of course, Haidi, as you mentioned, the tariffs. That could come next year, but also because we had the swap expansion between the Bank of Korea and the National Pension Service in that country, Haidi.
Shery, take a look at how we're faring when it comes to this Thursday session in Australia. We're extending gains for another session after we saw that leadership across banks and consumer stocks. Been a pretty broad-based rally for much of this week for Australia. We are seeing the ASX just hovering at about 5% to the upside there. We're seeing, in particular, when it comes to the banks and the healthcare space, seeing some leadership there as well. When it comes to Australian bonds, that 10-year real yield, I should say, is headed for that 5-week low, and we have seen really the Aussie as well as the Kiwi dollars really holding those gains as the month end hits the US dollar, and some of those moves play through there as well. We're back above 65, or just under 65 US cents there for the Aussie. Kiwi bonds are also declining after the RBNZ decision, of course, as we see really the sort of recalculation of some of these inflation expectations, with Australia's CPI gauge also missing the estimate, despite, of course, expectations for the RBA to stand pat. Treasuries looking like they'll keep that bid throughout the US holiday, and we're also watching commodities, in particular oil prices, a little changed at this point as we refocus on that key OPEC Plus meeting on Sunday. Shery.
Yeah, for more on the markets, let's bring in Naomi Fink, Chief Global Strategist at Nikko Asset Management. Naomi, always great to have you with us, especially on a day like today when I'm trying to figure out what the top news is. Of course, we do have the Bank of Korea, as I mentioned, but we're not necessarily expecting any change. This week, we've been dissecting what the tariff impact could be on Asian markets. What's top of mind for you?
Well, I think going into year end and next year, a new administration in the U.S., we're all to some extent playing the waiting game. We did have the initial reaction to the results of the election, but now that's old news. And now we're in the difficult situation of trying to separate the news from the noise. And while there is news, there's also, as tends to be the case when new administrations have not yet taken power, a lot of noise. So it's we don't necessarily want to make big reactions to policies that may not actually come to fruition. We've had some noise about tariffs. Will those actually happen, or are they just a negotiating tactic? We don't know that yet. So I think at the moment we still see some pretty robust fundamentals in the U.S. economy, for example. So I don't think there's any reason to think that's suddenly going to stop. But what I would advise is to take a healthy hedge against some of the tail risks that might be coming up next year.
Like spiking yields?
For example, we do have 120% U.S. debt to GDP. And even though if we have fiscal easing, that on its own might look really good for stocks, we also do have the fear that eventually that might lead to some unwieldiness of the debt, and foreign investors who are necessary to fund the U.S. current account deficit saying that they're not receiving enough of a yield premium. So that is always a risk.
And, of course, a stronger U.S. dollar that we continue to see right now, and the pressure on their counterparts across Asia. How big of a problem could this be for some central banks, like South Korea, for example? As I mentioned earlier, the BOK seems to be really focused on financial stability, despite the fact that the economy seems to be struggling.
Well, of course, the Bank of Korea's job is probably to take a look inwards at the domestic economy and respond to that. But I think it cannot ignore what's going on with currencies and the weakening yuan, for example. I think it, in some ways, it might allow the weakening yuan might allow the luxury to wait a little bit and see what actually comes to the fore in terms of news, because I think that's probably many of the economies in Asia right now, that we're actually waiting for the news to hit rather than reacting to the noise.
Yeah, you're waiting. It's a difficult game, right? Because you've seen a lot of corporates, for example, not wanting to wait. They think that they know what's going to happen. They're front-loading a lot of their moves ahead of going into next year, right? Is your gut feeling, based on sort of, previous expectations, is that President Trump the second time around will make good on all of his campaign rhetoric, and that we should expect him to do what he's said that he's going to do so far?
So if we're thinking about all the campaign rhetoric, I would think that's unlikely. Some, that's more likely. And I think that is the crux of separating the news from the noise. Some of it's news, but a lot of it's probably noise. And we do have the potential for some of what looks like news to be a negotiating tactic to achieve another end that's not necessarily apparent. So I wouldn't necessarily go hook, line, and sinker into all of the campaign promises. I would take a look at the likelihood of these policies materializing. Right now it's very confusing, but it should become clearer as we go into 2025.
When you take a look at some of the economies that he's targeted so far, obviously China is one of them, and it's quite interesting looking at what his potential US trade representative talks about in terms of a real fundamental revocation of the existing relationship, right? Do you think some of these economies, are better placed than others to withstand that? There's a lot of decorrelated assets in China that might be okay.
Well, yes, let's look at China for a second. The one thing that China probably has in its favor is that it hasn't dispensed a lot of the fiscal easing that it can dispense with just yet, and perhaps that's purposeful. Maybe China is waiting for the first move to come from the new U.S. administration, and then to try and react to that. It's keeping its powder dry. Right now, there is a pretty good issuance environment for Chinese bonds, and with those Chinese bonds, it's probably possible to finance quite a lot of new fiscal stimulus. So I don't think we're done seeing fiscal stimulus in China just yet. I don't think we necessarily want to trade on it right now, but there is some potential for things not being as bearish as initially perceived in China going into 2025.
Naomi, what's happening with the Japanese yen right now? I mean, this week I was a little bit surprised to see the strength that seemed to get started around the time when we heard about the tariff threats from Trump. And before, especially the past year, I mean, the downside pressure on the yen has been so strong that anytime we had some geopolitical risk or what we were supposed to think we could see some haven flows into the Japanese yen, we haven't. So what's changed this week?
Well, I think during the last year, we didn't really see haven flows into almost anything, even when geopolitical risk rose. Yes, for example, we saw strong gold, but that seemed to be to really try and gain a diversification away from the main event, which is basically major concentration in U.S. stocks. It's concentrated in 7 names. And perhaps we, too, don't think that it's time to get bearish on U.S. stocks just yet, but you need a good diversification tool. And I think that the yen right now is one of those diversification tools. Yes, it's not a relatively favorable yield that's attached to the yen, but maybe you can sacrifice a little bit of that yield, especially on the bond side, in order to hedge against some of the downside risk. And when markets do actually get a little bit frightened and there are risk-off trades, then the yen usually does benefit. So I think the yen is an important part of your global portfolio.
Naomi, great to have you with us as always. Naomi Fink, Chief Global Strategist at Nikko Asset Management. Let's get to our top story. And Bloomberg has learned that the US Federal Trade Commission has opened an antitrust investigation into Microsoft. We're told that they're drilling into everything from the company's cloud computing and software licensing businesses to cybersecurity offerings and AI products. Our legal reporter, Josh Sisko, helped break this scoop and joins us now. So, Josh, as we've just alluded to, it's a pretty wide-ranging investigation. Right. What do we know?
So the FTC today sent a pretty lengthy request for documents and testimony to Microsoft. It encompasses basically the entirety of their business, from cloud computing and their main enterprise software business to their burgeoning AI operations. It's kind of all the sort of key parts of the company that they're looking at, and it's the 5th or 6th company to be big tech company to be sort of caught up in one of these investigations. And now the process kind of will play out over several years.
Over several years, that could include, of course, that will obviously include a second Trump administration. So how are we expecting things to change with a different White House?
Well, it's a little hard to say, but I mean, that is the right question to think about. I mean, if they wanted to, it would be pretty easy for them to sort of slow the investigation down. Nothing about their process is public. It's been reported, but it's still a confidential investigation, so it wouldn't take much to slow it down. But the Trump administration, the first time around, was pretty aggressive against big tech companies. They opened probes of Google and Meta, Amazon and Apple, and they sued Google and Meta at the end of the administration, and all of those cases are still ongoing. And so I don't really see any reason why this wouldn't continue unless Microsoft was able to quietly kind of make a plea to the Trump administration to try to make this go away. But I mean, given the stance the first go around, I think that this is likely here to stay for a little while.
Our legal reporter Josh Cisco, as we continue to watch those tech stocks across the Asian session as well. We're watching in Tokyo right now, SoftBank under pressure, down 0.9%. We are hearing from sources that SoftBank Group is aiming to increase its stake in OpenAI by acquiring up to $1.5 billion in shares from the startup's employees. And of course, we have seen a lot of these SoftBank-backed companies, and one of them, Symbiotic, their shares dropped about 39% after the company cut its first quarter revenue forecast and announced it couldn't file its annual report due to accounting errors. So we're seeing a little bit of that pressure in the Tokyo session. We have more ahead on the Asia trade. This is Bloomberg.
Ukraine has called for strengthening cooperation with South Korea as Kyiv's defense minister travelled to Seoul to seek new sources of weapons. Bloomberg's Michael Heath joins us now for more. And it's interesting from a few different angles, right? Obviously, there's the North Korean involvement on the Russian side, but also is this ultimately about kind of filling the Trump-sized hole that will be left in support for Ukraine come January, potentially?
Yeah, they're good questions, Heidi. I mean, South Korea sort of has been fairly clear that it would only provide non-lethal support, but once North Korea, it's not only was it giving ammunition, but it was also sending troops now to Ukraine. That sort of changes the calculus. And for Ukraine, South Korea, it's a little bit like North Korea for Russia. It has so much conventional hardware, but the difficulty is, North Korea can hand over some of its additional rounds of ammunition, etc., because it's likely to be the decider in any war with South Korea. South Korea is only ever going to respond; it's never going to attack North Korea. So it just can't be quite so certain in handing over some of these supplies that it has. But yeah, I mean, look, it's a logical thing for Ukraine and South Korea to come together, but South Korea it's always in such a sensitive position. North Korea there, then China and Russia borders nearby as well. So yeah, it'd be very, very interesting to see what comes out of that. But it is in South Korea's interest to try and bolster Ukraine, and Ukraine is looking everywhere possible, for new sources of ammunition. And the Biden administration is also pressuring them to widen their draft to get more manpower as well, all ahead of the transition in January in the White House.
Because it's interesting. They're saying that it's not just ammunition or equipment. It's they need to get more people, boots on the ground, right? General Keith Kellogg seems to be tapped for special envoy to Ukraine and Russia, and he's someone who has said, we should cut off support if that's what it means to end this conflict.
Yeah, look, but he has said that, but it seems a little bit more nuanced with him. I mean, there's a lot of in some of his comments, there's a lot of Biden administration bashing, but through that there's also sort of the outlines of a strategy as well. He actually praised the Biden administration for allowing Ukraine to strike into Russia, saying that gave President-elect Trump more leverage in terms of negotiating with Russia. And he sort of doesn't want to see Ukraine, the West pouring money into what is essentially a stalemate. What it does look like, though, is that he's a bit naive in his comments about what negotiating with Russia is. He seems to be under this impression that Russia thinking that Ukraine was going to join NATO is what sparked this invasion. It was never anything about that. No one has ever suggested that Ukraine was going to join it. Even if it did, it would be a decade, it would be a long time off. This was always sort of an imperialist ambition. But nonetheless, he doesn't want to leave Ukraine alone. He just wants to sort of break the stalemate. And there's some positives in that. I mean, Ukraine is really struggling as it is, and there's only so long that these people can sustain hails of missiles on a daily basis. So something does have to change, and that's sort of the upside of the Trump administration. Whether they have the backbone to sort of deal with Vladimir Putin and accept what he's, what the reality of dealing with him is, what we'll have to wait and see.
Bloomberg's Michael Heath there with the latest on the Ukraine war. And we continue to see the developments around the tariff threats by President-elect Donald Trump, especially when it comes to Mexico and that 25% tariff that he wants to impose. He's now commenting in Truth Social, and he's saying that he had an actual conversation with the Mexican President, Claudia Sheinbaum, saying that they spoke on stopping the drug inflows into the U.S., that the conversation with Sheinbaum was very productive, and that Trump says that Sheinbaum has agreed to stop the migration through Mexico into the U.S. and that they will work on an ad campaign against fentanyl as well. So we continue to see the developments, as we've already heard from Mexico's side, including from the president, that this tariff of 25% that Donald Trump wants to impose could cost the U.S. economy as many as 400,000 jobs and increase prices for American consumers as well. Right, and talking about the economy, renowned economist Nouriel Roubini is warning that Trump's agenda of tax cuts and tariffs is shaping up as a double-edged sword for the U.S. The CEO of Roubini Macro Associates told us more about the potential impacts of Trump's plans on inflation and growth.
Some of the economic policies of Trump may lead to higher economic growth, being pro-business, keeping tax rates low, deregulate the economy, but unfortunately, many of the other policies are going to have an implication of higher inflation and lower economic growth. The first thing he has already announced is going to be tariff against Mexico, Canada, and China, and that's only the beginning. He has said we might have up to 20% tariff on all our trade partners, up to 60% against China. He wants to have massive deportation of people. In the last few years, the increase in migration has kept the lead on wage growth, has increased the labor supply, has increased economic growth. So definitely mass deportation is stagflationary. He wants not only to make all those tax cuts permanent, but he made other promises. No taxes on tips, on overtime, on Social Security, on income earned abroad, and so on and so on. It's estimated these things may add to the deficit by $8 trillion. Too much demand, inflationary. He might want to weaken the dollar. That's going to be inflationary. He may interfere with the independence of the Fed. Getting out of the Paris Accords is going to make climate change much worse, increase food prices and things of that sort.
It's interesting, Nouriel, a lot of things you just said are what a Bitcoiner would say as to why you should buy Bitcoin. There's now the Bitcoin ETFs. They're over $100 billion, clearly a big hit. There's talk that it could be a strategic reserve. You have gold in the portfolio. Is there anything that could move you to add Bitcoin to your ETF to help accomplish some of these goals?
You know, the Bitcoin is highly volatile. It can go up by 10% one day and down 10, 15% another day. If you want to have a stable store of value, you would not put Bitcoin into your portfolio. The kind of assets we're actually thinking about are all assets that do well when you have lower growth and you have higher inflation, whether it's tips, short-term treasuries. Gold is a hedge against inflation, debasement, de-dollarization, geopolitics, financial crisis, some exposure to ag commodities that are going to do well in a world of inflation and of climate change, and environmentally sustainable REITs. So it's a diversified portfolio of assets that historically have done well in these types of tail risk. I'm skeptical for a lot of reasons about cryptocurrencies and Bitcoin, because they're not currencies. They're not a unit of account. they're not a scalable means of payment, they're not a stable store of value. And if you want wealth preservation rather than high volatility, you want to stay away from those types of assets.
Roubini Macro Associates CEO Nouriel Roubini speaking with Bloomberg intelligence analyst Eric Bashinas. More ahead on the Asia trade. This is Bloomberg. Let's take a look at the latest on the corporate front. And Bloomberg has learned that SoftBank is looking to increase its stake in OpenAI by acquiring up to $1.5 billion in shares from the startup's employees. Sources say the Japanese company will make a tender offer for the stock, allowing OpenAI employees to cash in shares if they choose. SoftBank contributed $500 million to OpenAI's $6.6 billion fundraising round in October, but had pushed for a larger allocation at the time. Shares of Chinese driverless tech firm Pony AI tumbled in their US trading debut, erasing an early pop. The company's shares closed at $12 each in New York, $1 below the IPO price. Pony AI raised $413 million through its listing and private placement after delaying its pricing by a week as the firm boosted the deal size and addressed regulator questions. We will be hearing from Pony AI's co-founder and CEO, James Peng, on what's next for the company after its US trading debut. That's happening at the times listed on your screen, Shery.
And Haidi, when it comes to artificial intelligence, we're really seeing it being used everywhere, right? I don't know about you, but I already started my Black Friday shopping. And it turns out that people are trying to use artificial intelligence to get the best deals. So according to a survey, 44% of likely Black Friday shoppers say they will use AI this year, because you have seen companies like, we talked about OpenAI, Perplexity AI as well, that they've expanded their search and shopping features to get consumers to use their tools during the holiday season. And this will be a big blockbuster holiday season. Retailers bracing for the most shoppers on record over the Thanksgiving weekend.
It feels like Black Friday sales have been on, at least even here in Australia, which doesn't celebrate Thanksgiving or generally Black Friday, but over the years it's built up to be a really big thing. I feel like these discounts have been in my inbox for like the last month. But it's interesting, right? You talk about the record levels of Americans that are likely to shop. It comes at a time where, of course, there are extraordinary cost of living pressures. There's been so much uncertainty going into, the changing government next year, what has been, a really difficult election for a lot of people. Very, very interesting times ahead. So it's quite interesting that we are seeing so many shoppers kind of put their shopping decisions into the hands of technology and AI. So retailers like Amazon, Walnut also leaning into that to make shopping easier. This is Bloomberg. Take a look at how we're tracking when it comes to Asian markets more broadly, and we are seeing a bit of a divergence there when it comes to downside, when it comes to trading in Japan there. We have seen the yen really strengthening on the dollar, a weakness as US bond yields continue to fall. We have seen stocks more broadly kind of halting that record-breaking rally, particularly when it comes to big tech in Wall Street, and that's being sort of handed over. A little bit more of a muted session for Japan today. We are also watching some pretty good gains, another session of gains for Australia, up by just about 0.5%. Some of those healthcare names as well as banks continuing to gain, and more or less sort of treading water for the Kospi as we head into, of course, Bank of Korea decision day there. We're also watching in particular some of those small cap stocks, given the extended losses we've seen in the KOSDAQ. We've got a great story out on the Bloomberg about how we're seeing this rotation away from Korean small caps into Bitcoin, which of course at this point is again flirting with that $100,000 milestone level, Shery.
And of course, Haidi, we have seen that growing interest in the Japanese market. And now we're seeing global hedge funds and private equity firms gravitating toward Japanese companies in a bid to unlock as much as $165 billion in undervalued real estate. One company in the spotlight is Tokyo Gas, which jumped the most since 1987 last week after Elliott Management reported it now held a major stake. Bloomberg Finance reporter Lisa Du joins us now. So Lisa, what does Elliott want with Tokyo Gas, and how is this all related to real estate?
Yes, like you said, last week Elliott unveiled that it had a 5% stake in Tokyo Gas. And from our reporting, it seems like the stake is not really related to the Tokyo Gas utility business, but rather to the sizable real estate portfolio it holds. So Tokyo Gas owns a handful of office buildings and apartment buildings across Tokyo. And Elliott, I think, thinks that basically these real estate is not being really valued at their market's worth. Their thinking is that if Tokyo Gas can actually sell off this portfolio, they could maybe make about 1.5 trillion yen. To put that into context, that's about the same as Tokyo Gas's market cap. And then her thinking is that this money can actually instead be put to better use, maybe focusing on better capital efficiency or focused on Tokyo Gas's core business.
It was really interesting to see here Japanese companies having such large real estate holdings. I think recently I interviewed the Tokyo Metro head, and he was talking about wanting to focus on the real estate business. How much hidden value is there here in Japan?
Yeah, like you said, this is not a unique practice at all to Tokyo Gas. This is very common in Japanese companies. We have one Goldman Sachs estimate saying there's about 250 non-real estate companies in Japan that hold real estate, and kind of their worth, if the real estate was actually put on the market and sold off, could be about 25 trillion yen. And like you said, or in U.S. dollars, 165 billion U.S. dollars. Now, this kind of value distortion comes from the fact that traditionally Japanese corporates have liked to hold on to real estate. They own offices, they own hotels, they own apartment buildings. And what's happened is when they account for them on their books, they put them at cost, which is like the cost of acquisition or the cost of development. And then they depreciate that every year. So the value is quite low on the books. But at the same time, in recent years, you've seen the Japanese property market really boom. And there's a lot of investors here. They want to buy offices. They want to buy these buildings that they hold. So what happens if they're sold on the market, they can actually realize a large difference between the book value and the market value and book that profit. And that's where kind of this unrealized gain in real estate is coming from.
Why are we seeing this trend of activist hedge funds, PE firms really getting into this?
This is basically another way that these investors are trying to unlock value in Japan. It's now becoming more sophisticated as people have spent longer time in Japan and realized kind of where the value is. And and you've seen this not just with Elliott's most recent Tokyo Gas stake, with the real estate play. They've also done it with Mitsui Fudosan earlier this year. You have Singapore-based 3D Investment Management. They have holdings in beer maker Sapporo, as well as IT company Fujisoft, which is the middle of going private. And so these are all very thematically to the hidden real estate strategy. And on the other side, private equity firms are also finding that this is now quite a lucrative business that they could be in if they buy the companies and are able to sell off the real estate they hold. So we've seen this done a couple of times. Last year, KKR bought Hitachi Transport Systems, and just this year they sold off about 100 billion yen worth of warehouses as a whole to go on an asset-light strategy. But obviously, this is kind of a big focus for active investors, for private equity funds, and I think we'll be paying attention to it going forward.
Bloomberg finance reporter Lisa Du there in Tokyo. Let's take a look at what we're watching when it comes to major currencies that have been on the move. And of course, the yen has been one of them, and a lot of that has really been certainly within that G10 space, leaning on that dollar weakness that we've had. When it comes to the yen, that positives are really kind of enhanced by the fact that we are seeing that sort of holiday trading volume, a reduced FX liquidity situation around the Thanksgiving holiday in the US, and that usually means that whichever short-term direction prevails, we'll see kind of traders reluctant to stand in the way. So we are still seeing that sort of move there at about that 151 level. A little bit of a comeback there for that yen weak, the dollar weakness story, I should say. Dollar China is another interesting one to watch, as we've seen really a number of calls urging for potentially looking at a further decline in the yuan. JPMorgan seeing another 10 to 15% slide in the Chinese currency if some of these risks from the trade war materialize. And interestingly, it is perhaps an indication of how quickly these things can change, but the posts from President-elect Trump, the positive comments about his conversation with the Mexican president has moved the US dollar trading against the peso pretty dramatically. So there is this idea that if a deal can be done, if that makes incoming President Trump happy that perhaps some of these punitive moves on trade, on tariffs, could possibly be rewarded. The Kiwi is another one that we're watching at the moment, given sort of the rise that we've seen, the widely expected rate cut that we saw following Governor Orr's press conference as well. So that's suggesting there'd be a further 50 basis point cut in February if the economic situation evolves as expected. But a little bit of upside there for the Kiwi today. And the RBNZ has long been seen as a trailblazer for inflation targeting, but Governor Orr may now have tamed prices too successfully. Our Bloomberg opinion columnist Daniel Moss joins us now to talk about this. So first of all, you know, we watch the New Zealand, the RBNZ, so closely for an economy of its size and scale. Why do we see it as a benchmark?
So New Zealand was the first central bank of any consequence to introduce a formal inflation target. And it did this way back in the early 90s, before you and I even began in journalism. And this was a trend which was subsequently mirrored by pretty much everyone. You look at FOMC transcripts, they discussed inflation targeting as early as the mid-90s. References to New Zealand keep popping up in those discussions. So it really is a place to watch. The other thing is there is a history. Once they get going with rate cuts, they jack them up very, very aggressively, realize they've overshot, and then they start to come down very quickly as well. It's the latter phase that we are witnessing now unfolding. And as you mentioned at the start, the governor did nothing to discourage talk of a further 50 basis point cut early next year. Maybe the real story is how quickly inflation is coming down. And do they have to do a lot more? And does that say something about the inflation outlook more broadly?
But the fact remains that next year we have a lot of uncertainty, right? Already, President-elect Donald Trump is not even in the White House. We have tariff threats as well. So isn't it a little bit premature to talk about too low inflation when there are so many inflationary risks around the world?
Yeah, look, it's a great question. Let's wait and see what actually becomes law. You know, in the preamble to this discussion, you talked about Mexico. Don't forget, President-elect Trump, when he was in office the first time, called the US-Mexico-Canada trade agreement the biggest deal ever, probably all written in caps. And that agreement discourages, to put it mildly, the use of tariffs. So let's wait and see what actually becomes law. And that's what central banks are saying. But the data isn't necessarily going to wait for that. So the IMF is an institution which, has had a difficult history in the eyes of many. But their economic forecasting recently has been pretty good. There was a lot of fixation on the slight adjustment to their growth forecast, but also their inflation projections were pretty clear as well. This thing is coming down. The battle against inflation is over. Now, just as people flirted with the word transitory or terms like that in 2021 to kind of poo-poo the building increase in prices, is it possible we're missing the start of a trend that goes significantly in the other direction? South Korea, which has an interest rate decision today, inflation is now significantly below their 2% target. You're going to call this a global trend? Not yet. But as I wrote today, it's a very interesting test case that needs watching.
Yeah, we'll be waiting for that BOK rate decision any time now. Bloomberg opinion columnist Daniel Moss there. And JPMorgan now saying that China could allow its yuan to depreciate by as much as 10 to 15% in response to any trade war unleashed by U.S. President-elect Donald Trump. China correspondent Min Lo joins us now with more on this. So, Min, what are analysts saying about how China could absorb this tariff shock?
Yeah, I think it's widely expected that devaluing the yuan is going to be one of the most important tools that China has to counter those tariffs. So JPMorgan is expecting 10 to 15% depreciation of the yuan. But this, by the way, is pretty modest if you compare to what happened in 2017, 2018. The PBOC allowed the yuan to depreciate by about 30% in response to Trump raising tariffs at that time from 3 to 20%. But still, it is going to affect China's growth. JPMorgan saying that this could cut China's growth forecast from 4.8% this year to 3.9% next year. And plus, we're also seeing emerging market growth being cut by about 0.7% according to JPMorgan. And the countries that will be most affected include Malaysia, Vietnam. These are countries with big manufacturing powerhouses. India could be least affected, just given that it is less integrated with China. And meanwhile, you'll have Bank of America saying that traders are likely underestimating the impact of this trade war. They're projecting that EM currencies as a whole could depreciate by about 5% on average in the first half of 2025.
If this is less a negotiating kind of tactic and more of a structural change of the relationship, could that in fact be what we're looking at if you take a look at what we've heard from President-elect Trump's pick for the US trade representative role?
Yeah, I mean, Jamieson Greer is someone who has for a long time been a China hawk, and he has outlined some of his policies before. This is based on some of his speeches in the past. He has said one of his most extreme policies, in my opinion, is to end China's status as a permanent normal trading relations status, and that basically that was something that was granted to China back in 2000 when China was preparing to enter the WTO, and ending that status would essentially put China in the same category as the likes of North Korea, Russia and Cuba, for example. It would mean more levies on Chinese goods. He has also proposed that Congress passes this legislation to protect U.S. companies from retaliation from China. And what could this look like? It could look like compensation for U.S. companies that are not allowed to sell to China. It could look like punitive action against foreign companies that are taking advantage of this trade war to backfill orders to Beijing to replace U.S. companies that are not able to sell to the Chinese market. He has also proposed more investment restrictions, more export controls, more manufacturing support, something equivalent to the Inflation Reduction Act, but something that is much, much broader, encompassing broad swathe of the U.S. economy, including medical devices, pharmaceuticals, aircrafts, electronics, for example. So overall, a very, very hostile stance towards China.
And you would think then that China wants to diversify away from the U.S., but we continue to see them step up purchases of U.S. soy. What's happening here?
Yeah, so this is according to traders familiar with the matter. They are saying that there was a Chinese state-owned company that continued to buy up at least 8 cargoes of U.S. soybean last week. And according to the U.S. Department of Agriculture, another 2 cargoes were sold this week as well. And these cargoes, they will likely be sailing to China. The risk is that if there is a trade war that erupts after Trump's get inaugurated on January 20th, these cargoes could be stuck at sea if the tariffs are imposed before the vessels arrive in China. So that's the risk there. But it also makes sense that China at this time will want to sort of build up their national reserves and keep their food in as many doors as possible and not buy all their entire supply from Brazil at this time while, the tariffs are not yet in place. So we're still seeing the pickup in China's purchases of U.S. soy that was already happening before the election, and it's continuing now as well.
Bloomberg China correspondent Min Lo there. Take a look at how the offshore yuan is trading right now, still above that 720 level after touching that 4-month low against the U.S. dollar. Of course, on those tariff threats, a different picture for the Mexican peso, though. We are seeing a little bit of upside. The best day in 3 weeks after we heard from President-elect Donald Trump saying that he had held talks with President Claudia Sheinbaum, that the conversations were very productive and that they'll work together on stopping the drug inflow into the U.S. Still, when it comes to broader emerging markets, we are seeing the downside pressure, especially when you're taking away the potential of aggressive easing from the Fed next year. So we continue to see the broader downside pressure on the emerging markets basket of currencies. We have more ahead on the Asia trade. This is Bloomberg. Seoul right now seeing unusually heavy snowfall this week. Snarling traffic, grounding some flights. The first snowfall of the season. Dumping a record 17.2 centimeters of snow, the highest single-day fall recorded in November in 117 years. That really, really looks cold. Almost 150 flights were canceled on Wednesday, including at least 67 international flights from Incheon Airport. I do miss the snow here being in Japan, Haidi, because we're still to see any snow. I don't believe that we're going to get snow in Tokyo. It usually doesn't happen in the winter.
Oh, but doesn't that look, I mean, after the snow, it's always a mess and annoying to have to kind of navigate and clean up. But does that not look like the most idyllic thing you've ever seen? It's just gorgeous. Let's take a look at what we're seeing when it comes to Korean assets. And of course, watching the won in particular, right? We've had so much downward pressure on the won. It's been truly battered, and a lot of difficulty even for the Bank of Korea to kind of staying on hold seems, as Bloomberg Economics puts it, could be a futile gesture to try and support the currency there. The Kosdaq seeing a little bit of upside today with an interesting story talking about that downside in Korean small caps has really been at least in significant part as a result of that move to Bitcoin. But let's get some analysis when it comes to expectations from the Bank of Korea today. Our next guest thinks that the pace of rate cuts has been slower than warranted by domestic economic conditions. Juliana Lee is our chief APAC economist at Deutsche Bank. Juliana, great to have you with us. So it's difficult, right, because there are sort of domestic economic indicators that would suggest they should be moving again. On the other hand, a great deal of unknowns, and there's the issue of the won. We'll try and get back with Juliana in just a moment. But as we were talking about the Bank of Korea, we do have, oh, wow, it's a Bank of Korea key interest rate cut to 3% from 3.25%, Shery. We were wrong. Only 4 out of 22 economists surveyed had forecast for them to move today. The great majority of economists and investors, really broader markets, expected them to stay on hold, particularly when it comes to observing some of the uncertainties with the Trump administration, the impact of tariffs, of course, Korea's very domestically exposed economy. And, of course, we were expecting essentially a stay of execution for the won, at least, which has been so battered. It's been trading, of course, that combination of U.S. politics, longer-term expectations for rates in South Korea. We're down almost 1% since the election. But this is not going to help. The Bank of Korea cutting its key interest rate to 3% from 3.25%. Let's bring back in Juliana Lee, who's the chief Asia economist at Deutsche Bank. Juliana, I hope we have you. We're hearing now from the BOK that the 2025 GDP growth forecast seen at 1.9%, revised down from 2.1%. Inflation seen at 1.9% versus 2.1% in August. So do you think they did the right thing? Because you said a lot of these domestic factors means that they should keep cutting.
Yes, I think they did the right thing. We were concerned that the won's weakness and its priority, putting financial stability, will get in the way. But I think that it made the right decision. As far as its growth outlook is concerned, it's actually the cut to 1.9% for next year is consistent with our view. And in terms of the inflation, we actually have a lower inflation outlook than BOK, even revised at 1.9%. We're expecting 1.8%. I think that this is not the time for worry about financial stability as much as worrying about growth. The incoming data has been pointing to significant weakness in domestic demand, and that requires a response from the central bank. So I think they did the absolutely right thing today.
We're also seeing that, as expected, implications for the won, right, weakening about 0.3% as the BOK cut that main rate. When you take a look at the weakness that we've seen, both projections when it comes to CPI, when it comes to GDP growth for next year, seen lower as well. Do you think this adequately takes into account the potential implications from US trade policy?
In terms of the 1.9% growth for next year, it doesn't, because it can get far worse. I think it's basically looking at a limited sort of the tariff spat between obviously various countries with the United States, but a more significant, severe tariff act scenario will see actually a much weaker growth. So this is more of a relative benign view, and this is basically really kind of looking at a more of a sort of a benign environment versus a much more severe environment that we could see. And as far as in terms of the terminal rate for the BOK is concerned, we think that the 2.25% is probably the likely landing point for the BOK policy rate going forward, as opposed to 2.5 or 2.75 that people were looking at earlier.
We're seeing the market implications right now also with the Korean 10-year note futures rising to the highest since 2022 on that BOK rate cut. But what's the path forward, Juliana, when it comes to the BOK into 2025? And what will you be listening to when we get Governor Lee Chang-yong's press conference later today?
Right. I think one of the key reasons that it will mention in terms of the rate cut is basically the domestic fundamentals. The incoming data, especially since over the weekend, there'll be a number of reports, concerns about credit risks, rising defaults, especially with the small loans, and also surveys, a number of surveys basically kind of looking at, deteriorating sentiment. And so taking this more of a preemptive action as opposed to kind of lagging behind the Fed and just being reactive, I think is a good way of a starting point. In terms of how low it can get, obviously they'll be cautious in terms of, I think mentioning any levels because they worry about the Korean won. But in terms of, I think, dynamics, I think that they will probably mention that the risks to growth is clearly tilted to the downside. It can get far worse, but at the same time, I think they need to remain constructive to support the Korean won.
Right. Juliana Lee, Chief Asia Economist at Deutsche Bank. As we await that press conference by the BOK governor, we have gotten that surprise rate cut from the BOK. The expectation was for no change, but only 4 of 22 economists had thought that they would actually cut, and then they did. They went ahead to that cut to 3%, and we're seeing the market moves. We are seeing the Korean won depreciate. We're seeing the 10-year note futures also rise to the highest since 2022. When it comes to the CPI forecast for 2025, 1.9%, so it's a little bit of a downgrade as the economy there struggles. That's it from the Asia trade. Our markets coverage continues. This is Bloomberg.